It's Equity News on Equity Access, your daily insight on stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from Hampton Studios in Harare. Good evening and let's get on to business. I'm Ibn Mabunda. Now, on to our news tonight. Trade stats for the month of March are out with a trade deficit of $220 million recorded in that particular period. This is a 4% improvement from February figure, which came in at $230 million. Imports value was $560 million vis-a-vis exports of $340 million. Just to dive into the statistics so that you get an appreciation of where it is that we're coming from. Well, March of 2018, $317 million in terms of the trade deficit. August 2018, trade deficit of $127 million. Moving right up to December, where we recorded a trade deficit of $130 million. January 230, 220. Of note is the fact that during the year 2018, we recorded a trade deficit of $2.5 billion. And now Zimbabwe must see to it that we address that trade deficit. But just looking at how things are at this point, it seems as though we are set for a widening of our trade deficit position. Well, of course, according to the stats, as I just mentioned, that the exports figure of 340 vis-a-vis imports of $560 million. Moving on to our next story, ZSE listed manufacturer, which is Turnall, has released financial results for the 2018 financial year. Who is Turnall Holdings? Turnall Holdings is a manufacturer of fiber cement sheets, pipes, concrete tiles and pavers, as well as garden decor in Zimbabwe and the region. Revenue growing 69% to $32 million, mainly driven by increased sales volumes, while profit after tax of $3.8 million recorded an improvement from a loss position of $689,000 in the previous period. Well, if you just have a historical perspective into the performance of the corporation, you'd realize that in 2014 they had a net loss position of $13.4 million, an improvement in 2016 there was a decline as they recorded a profit net loss position of negative $5.1 million. Then of course it seems as though that the revenue seems to have been on a similar trajectory, twinning or following suit what the performance in terms of the profit is concerned. Now, moving right to 2018, we've recorded a profit of $3.8 million from a net loss position of $700,000. Again, there's a significant increase in terms of the revenue, which is a 69% growth from $19 million recorded in the comparative period, which is 2017. After years of liquidity challenges, the group has been able to record an improvement in its net current asset position. In 2017, the net current liabilities of $11.8 million, and now they've improved into a net current asset position of $2.2 million. Also, notably, is the fact that there is an improvement that is a result of a debt restructuring exercise that has seen the financial position of the corporation improving, recorded during the most recent released financial results. A sneak peek into the financials as Finance Director Sam gives a presentation. Let's have a look.
Which is an increase of 69% from 19 million in the previous year. Then in terms of product contribution to turnover, our roofing products contributed 77%, which is a 2% increase from 75 in the previous year. Concrete products volume contribution also increased to 21% from 19, and pipes, they were 7%, they are now down to 2%. We did not get in any pipe projects during the year, so we're selling maintenance pipes for maintenance, so there are no huge volumes when we are just doing maintenance. Then consolidated profit or loss, say turnover was, okay, I've talked about turnover, 32 million. Gross profit was 42% compared to 36%, so our margin increased by 6%. Our margin increased as a result of capacity utilization, which we have Our profit from operations was 6.5 million compared to 706,000 in the prior year. This is coming out of the increased sales turnover volumes as well as the improved margin. Finance costs were 649,000, which is lower than 1 million as of last year. So our debt restructuring is paid off. It has resulted in that decline in finance costs. And overall, we are reporting a profit before tax of 5.9 million, which is compared to a loss of 332,000 in the prior year. In the current year, the company will not pay taxes, as we have accumulated losses over the years that we will be utilizing.
In the same vein, ZSE listed Diversified Investments Group, which is First Mutual Properties, today released financials for the 2018 financial year. The group has several business units, including First Mutual Health, First Mutual Life Insurance, First Mutual Properties, TriStar, and recently they managed to acquire Nikos Diamond. As is the case across the board, financials were presented in US dollars in line with statutory instrument 33. However, auditors feel that this is in violation of international financial reporting standards, with particular mention to IAS 21. Well, getting into the financials, we realize that revenue increasing 45%, with First Mutual Health contributing over 50% in revenue. Highlights: First Mutual Insurance is relocating to Botswana, profit after tax scaling 44%. Let's get into the historicals to get an appreciation of how the group has performed over the years, moving right up to 2018. 2014, well, the group recorded a net loss position of $4.4 million, an improved position in 2015, $3.7 million. 2016, profit after tax of $9.3 million against revenue of $107 million. 2016 of $12.2 million against revenue of $116 million. 2018, this is where there is a revenue figure of $156 million, as well as profit after tax of $17.6 million. I had a close up with the group chief executive, Mr. Hoto. Let's have a look.
The major drivers of the revenue are the growth in Zimbabwe through the acquisition of Nikos Diamond Insurance, a short-term insurance company which is now the second largest underwriter insurance. Also the growth in the health business, but more importantly the growth in the Botswana business, which gave a 48% growth in revenue from about $7 million to $10.4 million.
Fantastic. I know you'd love to talk more about Botswana. The word Botswana was quite recurring during the presentation from yourself as well as the finance director of the corporation. But let's just talk about the acquisition of Nikos Diamond. How strategic is that to the group, firstly? Then secondly, you also did mention the consolidation of TriStar into Nikos Diamond. What can be expected in terms of that move?
Yeah, the acquisition is fits into our strategy, where we say that in the market that we play, we are either first or first second. So it gives us the position of being in the top two of the short-term insurance business in Zimbabwe. And the consolidation with TriStar will result in critical mass and reduction in unit cost. So this will mean that our clients who were hitherto could maybe not so confident in TriStar, a small player, will now find a one-stop shop where they can do their short-term insurance, their health insurance, and their life insurance.
Beautiful, beautiful. Now let's talk about the importance or the relevance of the $10 million bonds that you actually hold with Zimbank. How strategic is that to the group?
Thank you very much. I think, as I said earlier on, we are trying to move away from monetary assets by using our local money to buy a US dollar investment. We've basically dealt with even the change in the currency. We are well covered on that, and if you looked at that's why as a group, without even including Botswana, we don't have a net liability position, despite the fact that we were owing some real dollars. We were properly hedged by that kind of investment. So it's key for hedging, but not only that, it's liquid, and it helps us if you want to raise capital to do other things, even in the region.
I realize. Now to talk about the relocation of the reinsurance business from Zimbabwe into Botswana, as well as the $6 to $7 million raise that you did actually allude to. Would you want to shed more light where that is concerned?
And so when you are domiciled there, you offer a much better security in terms of the other people coming to. So our expectation is that once we do that capital raise, we expect the business to inch towards a 25 million US revenue, real dollars, in the next 2 to 3 years.
Botswana. You, according to the presentation, you have more assets in Botswana than in Zimbabwe. Does that speak to the strategy of the corporation going forward?
Yeah, insofar as just the reinsurance for the whole group, we still have more assets in Zim. But of course, insurance component, there are more assets in Botswana. Yes, it speaks to it because reinsurance, by its nature, is an international business. You need to be able to settle claims from anywhere in the corner of the world. So, being in a country where there is easy movement of foreign currency takes you exactly there, and also you need to pay some of that dividend back into Zimbabwe, where the original investment came from. The major drivers of the revenue are
listed Vast Resources announces that it is ready to start diamond mining operations in the Marange fields. The development comes after the mine announced a positive update on financing and the right to mine diamonds at the heritage concession. In addition, the company has advanced discussions with a potential cornerstone equity investor to the extent that the investor has now expressed a definite interest to proceed in principle. Last year, diamond explorer Botswana Diamonds concluded an agreement with Vast, which is set in motion the development of the concessions in the prolific Marange diamond fields. Of course, last week the corporation actually did dispose of its gold mining rights in the country so as to focus all of its resources in diamond mining in that particular order. Now we will take a short break. When we come back from the break, we'll have a look at the news in detail. Please stay tuned. Welcome back, viewers, for the news review. I'm joined in studio by investment analyst Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Good evening, Eben. Good evening, viewers.
Fantastic. Also, part of the panel is Chief Analyst Respect Gwenzi Respect. Good evening and welcome to the show.
My pleasure. Thank you, Eben. And good evening, viewers.
Fantastic. Let's get the ball rolling. We are in what seems to be a reporting galore with several companies set to actually release their financials. But before we can delve into the financials, let's just start by having a look at the trade stats that have just been released, with $220 million recorded in terms of the trade deficit for Zimbabwe. Gentlemen, what is your assessment of this particular situation? I'll start with you, Respect.
So the cumulative trade deficit for January and Feb is now at 450. If you do a simulation, it can point to you towards a lower trade deficit figure for the full year. But I think our import bill is likely to increase as we get more into the year. But for now, we have managed to thwart our export growth. I'm sure from January, we're now realizing a decline getting into Feb, and I believe that momentum can be sustained. There has been less in terms of forex resources on the interbank market. This obviously is one of the key drivers of a decline in imports, and the basic rise in costs locally has also made people buy less in terms of just general demand. So I think some of those factors are likely to further reduce our import bill. But when you look at the export side, we are not doing fairly good. It's a decline as well for the month, coming in at 500 as actually 340 million in terms of the net exports for the month. Gold exports have not been that firm, and number two as well, we are looking at lower tobacco produce for the year. Those are some of the key products that we export on a year-on-year basis, and if they come off, then that means we might also see a net decline in terms of the general exports for the whole year. So the trends are pointing towards a depressed import bill, but also a depressed exports bill as well, and we might see a sustained net trade deficit position, but maybe not as wide as the prior year.
How important is what we see playing out in terms of our trade position?
Maybe to add on what respect has just said, the decrease in trade deficit is just a net impact of the controls that we are seeing, the indirect controls that we are seeing in terms of imports, which is a result of a lack of adequate forex to pay for the imports. But if you look at the current economic setup, we still have high appetite for imports, which if the forex position improves, you might see the imports actually rising fast. At the same time, on the export side, the decrease in export also maybe speaks to your constrained productive capacity. Traditionally, our manufacturing sector used to contribute as high as 34% to the export basket. But if you look at the current levels, due to rapid deindustrialization and constrained capacity in terms of the access to key raw inputs, we have seen a contribution of your manufacturing sector dwindling to below 15% of the export basket. So there is actually a lot that has to be done in terms of promoting the productive capacity, especially of the manufacturing sector. So it goes back to the basics. We are in an agri-driven economy. Whenever agriculture underperforms, your manufacturing sector also underperforms. The mining sector, yes, is there to augment the linkages between the agriculture sector and the manufacturing sector, but more value comes to your industrial sector, which is your manufacturing sector, which is directly linked to your agriculture sector. So we have a bad season in terms of the agriculture. So I'm seeing the manufacturing sector, which is also constrained in terms of or which is actually deprived of the key raw inputs. So the manufacturing sector, for it to continue ticking up, it means there is also a high demand for imports, which is actually a bad position in terms of our deficit outlook. So I don't see our deficit coming down that much. I'm seeing pressures being elevated in terms of our trade deficit.
Okay, now making progress, getting into our next story. Turnall releases financial results. They're coming from the red and are now back into the black. A positive performance, growth in revenue of 69%, profit after tax also scaling, of course, from a net loss position of $689,000 to just about $3.8 million. Well, perhaps you'd want to get into the details of what is your assessment, as well as the details of how you feel concerning this particular company. I'll start with you, Tenashi.
For Turnall, it's a company that is actually directly linked into which is actually deeply into the construction sector. If you look at 2018, there was investment in infrastructure by both the government and also by private players, who were much excited, by this high optimism in terms of the economic outlook after that soft change in the political environment. This is actually what has been, driving, the volumes and turnover, which sustained, the revenue growth from the 19 million to 32 million, which also gave a positive outturn in terms of profit after tax, from a net loss position to a net profit position. But going forward, the construction companies are actually directly linked, by the capacity of the government to continue financing infrastructure projects. In terms of the construction industry, the government plays a critical role in terms of financing those key infrastructure projects. But the positive side is we have seen that the government is actually focusing more in terms of resuscitation, the key infrastructure, which I see as a positive for these companies that are into that space. So this year, in terms of the figures, there's a substantial amount that was set aside by the finance minister to finance the key infrastructure projects, which I think Turnall is positioned to tap into that space.
Now let's talk about the improved performance. What impressed me from the briefing was the fact that they have been able to their finance cost position moving from $1 million in the previous year right to 600,000. Not only that, last year, which is 2017, the previous year rather, they had net current liabilities position of $12 million, and now they're into a net current asset position of $2 million. What is your understanding or interpretation of how they have actually performed in that particular sector?
So I think what underpins the current resuscitation or the current growth momentum, it's basically a restructuring program which was undertaken in 2016 when Turnall sold off its 7.2 million debt to Zamco, and Zamco had to give them a lengthier period over which they could pay back that money. So that actually freed up some resources within the institution. And so, as you have correctly mentioned, they were in a technically insolvent position, which means they couldn't fund their operational needs, as well as obviously actually managing to report a profit position, because most of their resources would be chewed by the tax liabilities. So now getting into 2017 and 2018, we're seeing a freeing up of resources, capacitation in terms of working capital, and obviously they've been able to capitalize on prospects within the construction sector as well, the construction sector basically. But I think they've also tapped into the agri sector. They've highlighted that they've really found the tobacco business to be beneficial to them. They've been building barns and so forth for the agri side of and they're seeing prospects within that area. So it's actually key that the construction sector as well as the agri sector have fed into the growth that they've now been realizing. So this is exactly my interpretation of what this whole turnaround in terms of insolvency means. But like as Tinashe said, going forward, it's a whole lot of factors at play. The construction that's envisaged to be the construction activities that are envisaged to be undertaken by government might not really come through as expected because of shifts in terms of loss of local money value, which might render some of the contracts they might fail to be executed because of the increase in cost. So I think that's one of the drawbacks in terms of construction endeavors by government in the current year. But on the mid to long term, I believe they're rightly positioned to take advantage of the growth prospects that may come in Zimbabwe, that may arise in the economy.
All right, now moving on to another company that did actually release financial results, First Mutual Holdings. They released their financials today, and of course I'm sure there's a lot to talk about in that particular story, but let me just get into the financials and so that we talk about it from that particular lovely. Now, okay, revenue increasing 45% with First Mutual contributing 50% in terms of the revenue, and then of course you also have a profit after tax which increased 44%. How important is that to the group going forward, Tinashe?
2018 was a good year, especially for First Mutual, and we have seen even the numbers they are speaking to it. An increase in profit, if you look at it, some of it was actually driven by the positive effects of that asset revaluation, and even the positive, contribution or the positive gains on the stock market investments. They actually, drove upwards the funds under management for their wealthy business. On the life and the insurance sector, we have also seen First Mutual enjoying a growth or a steady rise in terms of customer acquisition, and also in terms of the net premium written. They also reported a decrease in terms of the claims, which is actually a positive for one of the largest insurers in the country.
Okay, over to you, Respect. What is your comment on the results that have just been published?
I think this is a fair result. There's been a lot of changes at First Mutual. Of course, the notable one being the bringing in together of Trista and Nikos Diamond. So all the operations are now, the short-term operations are now under Nikos Diamond. So obviously that also contributed in terms of inflating the numbers a bit. But there's the issue to do with equity investments, growth in that regard. And there's also been some revaluation, upward revaluation on the property side, and obviously that contributed to a growth as well. And when you're looking at the premium business, there's been a growth along all the classes, be it Old Mutual, the life side of the business, the pension sides, and so forth. So all these realized respective growth in terms of premiums, especially in the from the fourth quarter onwards, as the company adjusted premiums that they were taking from the public. So all those factors contributed to a growth in the top line, and of course in the bottom line as well.
Key to the presentation is the fact that the group is actually expanding, or should I say enhancing its footprint in Botswana, and they've already of course recorded positives in that regard, and particularly the relocation of the reinsurance aspect of the business into Botswana, and they're looking to raise capital of about $6 to $7 million. Now, can you explain the possibilities or the prospects that come along with that particular development? I'll throw this one back to you, Respect.
So Zim has become a risk market, especially from the reinsurance side. Why? Because you are tapping into risk from outside Zim, which has to be paid for in real US dollars. So the disadvantage in an economy where forex is in scarcity, you then realize that they were finding it difficult to repay or to settle some of the dues as and when they were demanded. So they are now taking off the reinsurance side of the business from Zim, and if you then locate the headquarters outside of Zim, you actually improve in terms of the liquidity, in terms of repayments to due clients and so forth. So I think this is a very strategic move. All the reinsurers in Zimbabwe, they're actually planning to do a similar move. If you look at FBC Re, there has been talk of a similar move to register in Mauritius. If you look at Baobab Re for Zimre Holdings, they've also gone a similar route. So these are efforts by local companies to try to diversify as well as to hedge themselves against the risk associated with retaining operations in Zim. But on a macro level, it also means it deprives the nation in terms of income that could have been otherwise earned for the country, because those taxes and whatnot will now be paid in jurisdictions outside Zim, only for marginal profits to be remitted to the holdings company in Zim. So that's about just the macro level. But at micro level, I believe this is a prudent way of managing the business.
Okay, now Tinashe, lastly on the particular subject, Nikos Diamond is acquired by First Mutual Holdings, and now with the acquisition, the group is also talking about a consolidation of Trista into Nikos Diamond. How useful or effective do you think that will be in addressing the problems that have actually beset the company Trista?
I think they are trying to, to restructure their business to make them more agile in terms of, reacting to this current economic environment. You find that when the economic environment is not doing that well, as a business, you have to be also responsive, and you have to structure your business in such a way that they becomes more lean and more agile and more, flexible in terms of, responding to the demands of the market. So consolidating or combining their operations into one unit is actually something that's positive, and that will also make them, dominate that space and even increase their share in that space as well.
Well, thank you for the insights, gentlemen. We're just going to take a break. When we come back, we will look at the performance of FBC Bank. I know yesterday we reported on the FBC holdings, but as a comprehensive group, decided to break it down. So tonight, we will also have a look at how the bank itself has performed. Please stay tuned. With investment analyst Tinashe as well as Respect. As I said, we're getting into FBC, how they've performed over the past year, which is 2018. Well, of course, according to the financials, net interest income growing by 63% on year, while total income went up 67%. Tinashe, I'll start with you. How important is this particular performance given what has been playing out in the economy?
This is actually a solid performance from one of the well diversified financial services group. If you look at what drove their revenue, interest income continued to be the major driver of their total revenue, which is actually a positive, for a bank. Banking sector, as I always say, is their core business is actually allocating resources, taking from those individuals who are in a surplus position, like your net depositors or savers, to those who are in a net, deficit, your borrowers. So when you are seeing a bank, especially a bank which we may call entirely a domestic bank, having such a performance is actually positive. For FBC, the good thing about this bank is it has been also able to attract significant amount of lines of credits, which were actually able to, which actually made it possible to increase its your risky assets, which is actually your loans. We have seen actually a steady growth in the loan book, and also a growth also in other your risk weighted assets, such as your bonds and debentures, which actually contributed to this good growth in net interest income from your 27.3 million last year to the current 44.5 million. Fees and commission income has also been on an upward trajectory, benefiting from its investment in IT-driven solutions, and also benefiting from digital platform as well. This is a bank also that has been also aggressive in terms of increasing its footprint as well, and also increasing its e-channels as well. So the good thing, what I'm seeing in terms of these results, interest income, especially in a weak economy, sometimes it comes at a cost of increasing NPLs. But for FBC, that's not the case. its NPOs actually they went down from 4.4% to the current 1.1%, which actually speaks to the quality of its asset book. It's a bank that has been strict in terms of security on its loans. So this is actually a very solid performance by the bank, and we have also seen profit responding positively, increasing more than doubling from 12 million to 28 million. That's actually a solid performance.
Okay, over to you, Respect. Your assessment of the financial results.
I largely concur with Tinashe. If you see all the income lines are trending positive, that really shows you that there's something that the bank is doing right. And but then if you look at the general banking sector performance, I mean the overall banking sector, there's been growth in all lines, which largely stems from macroeconomic developments, especially to do with growth in money supply. I think that there's been a growth in terms of general deposits in the economy, and with those deposits, it means people are also transacting at a far much higher level, and in line with the growth in aggregate demand, it also means transactions volumes are also growing. So you are likely to then see a growth in non-funded income, especially the fee and transaction income line. If you're now getting to this other side of interest income, the most notable key driver of that line has been loans, but interestingly for FBC, there has been growth in either lines, which is treasury bills as well as the actual loans. And for other banks, for example, if you are to look at FCB, in fact most of the banks I'm sure they're at an average of about less than 50% of their interest earning assets are now being allocated towards loans, and much of their assets are now being committed towards TBs. So I think this is also a good thing, that they are still loaning out to the industry and they are able to drive their interest income upwards in that regard. But I think this is largely to do with macro dynamics, and as we go, I think they will try to be more cautious given the hazards in the environment. But once a review is done to the interest rates, then of course we might likely to see possibly further growth. But most companies have been consolidating their positions. Some have been more cautious given the challenges around weaker rates relative to inflation. And when you look at other units at the group level, they've been performing good. But specifically for the bank, they've mentioned issues to do with interest income, the interest expense line. They want that to come down to highlight the brand equity that they have gained over the years. I'm sure the CE mentioned something to do with the growth in deposits level being a demonstration of the brand equity which they have accrued over the years, and they believe that against that their interest expense should also come down. I concur. I feel that the bank is a strong bank. Its brand equity is also growing in the market, and therefore its cost of funds should also come down. So I believe that can be realigned as we go forward. So basically, the performance of the bank was in line with expectations, and its position for further growth, further lines of credit from outside might enhance the performance as well.
Okay, now to talk about interest rates, how they've been calls now for a revision in terms of the interest rates. How could that affect the performance of the group or going forward? Very quickly, Tinashe.
Especially for FBC, we have seen a 100 million addition to its loan book. So if interest rates are reviewed upwards, it means that it's an additional income to the bank, given its high exposure to the private sector. But also maybe another factor maybe to add on, which is not on our numbers, is its bank's exposure as well to the private sector through debentures and bonds. This is a bank which is actually very active in the bond market, and I think for last year it issued bonds which may add up to 225 million. Much of it was financing key infrastructure projects, including your agriculture sector and even including also your dam construction in partnership with IDBZ and other key institutions. So this is a bank that's really up there in terms of supporting, your key economic sectors.
Right. Now, on to Respect. Stanchart came out and they said they want to increase their transaction charges. Are we likely to see FBC follow suit?
I believe it's in line with market dynamics. You have to operate at a profit, and I think every business operating Zim has to adjust costs to address viability. Because even if you are to invest in your e-channels and whatnot, you still need to be operating in a way that allows you to invest in those lines. So I believe it's gonna be market wide. I believe FBC is going to follow the same route.
Well, thank you, gentlemen, for the insights. Thank you, viewers, for watching. Please stay tuned. Up next is a focus on the performance of the stock market. Welcome back, viewers. I'm now joined in studio by our very own investment analyst, Anesu Chumbumo. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Can't want to complain. You don't get better yourself.
I'm all right, thank you.
Fantastic. Please take us through the stock market.
Well, the stock market is on the positive again today. All share index was up 0.11% for it to settle to 125.97 points. For the industrial index to actually follow suit, coming up 0.17%, which was the heavy moving index of all four indices actually coming up to 420.42 points, while the minings index did drop about 2.48%, pretty much consequent to two of the three weightier counters within that index having come off 5% and 2% in that respective order, while ZEC top 10 index added about 0.14% for it to settle at 119.38, pretty much consequent to 8 counters on the top 10 index moving northwards, while one was in the red and the other was pretty much stable.
Anesu, BAT at this time of the year, this is the time when we expect to see a positive trajectory, but as you can see from the graph, on a week-to-date basis, there's actually a decline of 1.67%. Not much of a decline, but so much uncharacteristic
earnings may not be as positive as a result of depressed volumes that are coming onto the trading floors. These guys are pretty much into a lot of processing, tobacco processing. So that means if there's going to be less tobacco that is going to be coming in on the trading floors, that could actually affect their production numbers unless they have solid levels of volumes that should be coming in through their contract farmers that they would have had some prior deals with. But then most of the volume effect is coming from the cyclone, from the El Nino drought that will be pretty much affecting the quality, the weight, and also the volumes of the tobacco leaves that will be produced in this season.
I realize.
Well, moving on to our 5-day trend, the all share index is up 0.75%, while the industrials index is up 0.81%. Now, the top 10 index has been pretty much the market leader for the past couple of days, weeks rather, but then it seems to have a weaker gain on a top 10 on a 5-day trend now, mostly because a lot of top 10 counters have much to do with foreign investors, but then it looks like there's a lot of foreign sell-off that has been happening, then translating into some local investors picking up some of those shares, and most of the shares that will be found on the industrial index, which is now up 0.81%. To about 420.42 as of today. So with that dynamic in play, it has shifted the weights between the top 10 index and the industrial index, coming from 0.36% to 0.81% for the industrial index, while the mining's index is down 2.36%. Now, for our risers and fallers, today we did realize a decline in terms of volumes traded as well as values. Well, this has much to do with it coming from a very high base. Yesterday there were trades amounting to about 13 million. Today they only came down to about 7 million, which is not a bad number for an average trading number in terms of how the trades have been going in the past couple of weeks. But it coming from a high base, it would seem as if the market was pretty much suppressed today, but then demand is still pretty much firm in the market, with medtech coming up 33.33% for it to settle at 0.012 cents, 0.12 cents, while Masimba added 4.76%.
Of course, Masimba released a positive performance in terms of the financials a few days ago, perhaps hence the positive performance in the particular regard.
Yes, it could be that, and then also adding on to the fact that it now coming out of the closed period, some of the board directors and managers could also play a hand in the market now, because it is by regulation that some of such company representatives cannot have a play in the stock market during closed periods. So for us to have a look at the other end of the yardstick, where we had about we had about 6 laggards in the day. Bindura Nickel Corporation did come off 5.3%. I did mention earlier on that this is one of the weightier, which is actually the weightiest counter in the mining's index, coming off to settle at 5.54 cents, while Rio Zim, which is the second weightiest of that index coming off 2.15%. Now, normally you'll find that there's four counters in the mining's index, as we have known according to history, which would be adding on Wange Colliery and Falgood, but Falgood was recently suspended for failure of release of financial results,
and of course
a
whole lot of stories.
Simbesa settled at 80 cents, Cassava 107.81 cents, while Axia at 35.98 cents, capping that set of laggards after having led up about 0.06% on its share price. Now the interbank rate has weakened further again to 3.19, while the parallel market also is weakening by the day to about 4.45. Now some traders have been trading around about 5, around about a rate of 5, but then we also then factor in the issue to do with how the parallel market factors in cost of withdrawal from EcoCash transactions, which is ranging around about 15 to 20% on a daily basis currently. So that difference then discounts with the level of our parallel market rate down to about 4.45, but then generally the RTGS rate is hovering around 4.7 to 5, while the cash rate is around about 3.6 to 4. So with that discount in mind, then comes the problem. The old mutual implied rate did come off today, while the JSE counter did go up versus the ZLSE counter being stable. So that then increased the disparity between the two.
Well, thank you, Anissa, for the insights. Thank you, viewers, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From the team and I, Danke and Asante Sana.